Wells Fargo has been in the news for some controversial banking tactics. Rick Parsons is a seasoned and published banker. He joins us today to help us understand what Warren Buffett sees in the company and how individual investors like you and me should respond. Rick also shares a proven method for knowing when to buy bank stocks and what some of his favorite current bank positions are. Welcome to Investor in the Family Radio, a podcast about learning to invest. My name is Brian Bain, and I'm your host. At Investor in the Family Radio, we believe that you can become a great investor. How? By building the right plan and then sticking to it. According to Warren Buffett, that is what it takes. So everything we do here is meant to help you accomplish both. So thanks for joining us. You can always find more at investorinthefamily.com and subscribe to the podcast at iTunes, Stitcher, and the Google Play Store. If you'd like to receive the next best thing to a transcript of this episode, that is my personal notes taken during the interview. They can be yours. To get these notes, simply text the word Family Notes. That's one word, Family Notes, to the number 44222, or visit investorinthefamily.com and sign up, and we'll be sure to take care of you. Do you like shopping for insurance? Of course you don't. It can be a terrible experience, especially when it comes to life insurance. But if you have loved ones that you want to take care of financially after you're gone, then you may want to consider term life insurance, and Policy Genius is the easiest way to get insurance, period. At Policy Genius, you can figure out what you need, compare the top policies, get covered, and save. If you want to save on term life insurance, go to investorinthefamily.com/policygenius. That's investorinthefamily.com/policygenius for access created specifically for Investor in the Family listeners. I do get a small commission if you use my link, which costs you nothing. It's a win-win. Visit investorinthefamily.com/policygenius for more info and have the most enjoyable insurance shopping experience you've ever had. Hope you enjoyed today's interview with Rick Parsons. Well, hey, Rick, welcome to the show.
Thank you, Brian.
Well, it's a pleasure to have you here with us. And if you don't mind, as we get started, giving us a really brief background on yourself as an investor and maybe what you're up to these days.
Well, thank you, Brian. Actually, my primary interest as an investor is to not make mistakes and to learn from mistakes I've made in the past. And I suppose in terms of your focus today, which is on an article I wrote for Seeking Alpha not long ago, my main focus is banking because that's what I did for 31 years of my career, retired 5 years ago. Since that time, I've written 2 books about the topic and continue to be very active in banking, including in the investing side. Excellent.
Well, that definitely gives you a lot of expertise with our conversation today regarding Wells Fargo, which obviously at the beginning of the month was not in a very pleasant position, and which is around when you wrote your article. But one of the things that I really liked about your article is the fact that well, obviously it's no secret that Warren Buffett or Berkshire Hathaway has a very significant stake in Wells Fargo, and Warren Buffett is a very respected investor. And so a lot of people were curious how he may be responding in the midst of what was happening at Wells Fargo. And you wrote a really thorough article about that. And so I'd love to hear what for those of us or those people who may not have read the article at this point, could you lay out the overall thesis of your article and kind of maybe some of your findings?
Well, I can, Brian. Thank you. Couple background thoughts first. It was only in August that I first started writing a couple articles for Seeking Alpha because I was very impressed by some of the articles I was reading, but I was also struck that some seemed to be sometimes lacking in facts. And my approach as an analyst of banks is to have as much data as possible. And in fact, that's why I started writing about banking overall, is because I felt like bank directors and even many big investors don't always have the facts about banks. And so as I was reading different articles about Wells Fargo, Warren Buffett interest in the bank kept popping up, and for good reason. He owns 10% of the bank, and that's a number that's been increasing over the years. But I also noticed that often there weren't accurate descriptors of his actual interest in the bank. And so my motivation was to just do for my own work an analysis of what exactly is his interest in Wells Fargo, why did he get into it in the first place, and what has he done with those shares over the years.
Right. And so what were some of your key findings? Of course, you started out the article by tracking the entire track record of his initially getting into Wells Fargo and at some point selling some shares, then increasing his stake, and all the way up into where he is today. So as you look back over that lifespan of his investment, I guess we could start by just figuring out, why did he initially get into Wells Fargo to begin with?
He bought his first shares of Wells Fargo in 1989, and he bought them in 89 and early 90 because basically the market was handing him a great franchise, very, very cheap. Bought it 5 times earnings. And if you know your history and you live in Dallas, so you may have lived in Dallas in 1989, 90, as I did, banks were anathema. Nobody wanted to invest in banks, and he found an opportunity where Mr. Market was giving shares away. And overnight, it basically had 10% ownership of the old Wells Fargo. And I think that's an important distinction. This is the real California Wells Fargo that ultimately got sold in 1998 to Norwest. And so when we think of Wells today, really it's not Wells of California, it's Wells of Minneapolis, aka Norwest. So the punchline is by 1996, his shares had increased in value by 4 times. 2 years later, the bank sells to Norwest. That's in 1998. And during that late 90s period, the valuation on the new Wells Fargo goes sky high. And that's part of the bubble in stock prices you were seeing all over the place. And he began unwinding shares. And so he sold a good percentage of his ownership by 2001.
And so a lot of that really was just him recognizing the fact that, while not necessarily not liking the bank as a company or otherwise, but just noticing the extreme evaluations and wanting to capitalize on that.
I think we could infer that. He never actually said that, although in later writings, and by the way, as research for this, first off, just as disclosure, I've been a longtime shareholder in Berkshire Hathaway, but my research went back to reading every one of his letters in the Berkshire Hathaway annual report since 1989. Oh, wow. Now, Wells has only been mentioned 10 times in those letters, and he never explicitly said why he sold those shares. Because
that's really out of character for him to do that, isn't it?
Well, at that point, you would have thought so. As we look back, yes, Brian, it is out of character, because by 2004, he was calling it one of his big 4 share holdings. But that's because in 2002, he resumed buying. But my theory is that I think you're right. He sold because the market was overvaluing the shares. As you may recall, Benjamin Graham was his teacher at Columbia in the early 50s. He wrote one of the great classics of investing, The Intelligent Investor.
I know well. Right.
In it, yeah, and a lot of investors would be wise to spend a lot of time just studying his Benjamin Graham's work. But anyway, what we know is the PE and the price to book went up when multiplied by each other close to 60, and that's about 3 times greater than the value Benjamin Graham would suggest is reasonable, and that may explain why he sold. Now, the other possibility is he just wasn't enthralled initially with the new Wells Fargo. And because he locked in on the old management, a guy named Carl Reichert, the original Wells Fargo, and he may not have been as enamored initially with the new guys, but that changed pretty quickly, because by 2002, 2003, he liked the new management led by a guy named Dick Kovacevich, who's a real neon sign, big success story in banking.
Right. And so in 2002, he resumed his purchasing. And so when he sold in late 90s, you said around then he had approximately 10%. Do you remember how much he sold down to, and then what he came back up to in 2002? Approximately.
Yeah. In fact, in the article I wrote for Seeking Alpha, I actually provided a couple charts on showing his cost basis, but the total ownership of the bank for him declined in terms of his cost basis from about $500 million to $300 million.
Okay.
So during that 5 years. And he kind of sold shares, Brian, slowly. He didn't just dump them all at once, which says a lot about him as a seller. But in the meantime, while he was doing this, his ownership interest in terms of market value of those shares was now 4 times what he had originally invested. So he started with a leg up, but by 2002, I think he was actually 10 times his cost in terms of its valuation. So he'd done very, very well.
Right. Man, there's a lot of things I want to ask. I'm really curious what you think. And again, this is, of course, your background in banking and then your study of Buffett in this. First of all, the fact that you read all of the letters from 89 until all of the Berkshire Hathaway annual letters written by Buffett from 89 till today, we could talk a lot about that. But I'm wondering, as far as him buying back in 89, you were in banking in 89. Did you, at the time, did you think banks were, something you don't want to touch with a 10-foot pole, or were you also thinking, man, this is a great opportunity and to invest as well, or what was going on then? And what, I don't want to embarrass you if you weren't thinking that, but
no, I was actually buying, and rules had changed since then. But I was indeed buying. I was buying Southeastern banks. My career has been as a banker all over the world, but at that time I was principally in the Southeast. Then my bank bought the 2 biggest banks that had failed in Texas, so I moved there in 90. While I was in the process of moving, I bought shares in a couple Southeastern banks, one of which, much to my surprise, was bought by my bank, within a year. And so, so I had to disgorge those profits just because it always looks bad. But yeah, I think that was historic opportunity, as again we saw in 2009, 2010, an opportunity to invest in banks.
So really, just an extreme scenario where people are thinking, because of the climate of banks, there's a lot of overreaction, and people who are sober enough to realize banks aren't going away. This isn't the end of banking. Therefore, at these valuations, it's kind of an opportunity you can't miss out on.
Yes and no. We got to be real careful about that, because think about this. In 1980, when I started my career, there were roughly 20,000 banks. And now today there are less than 6,000. Of that reduction, 3,500 as a result of failure. So bank failures is a huge issue for U.S. And in fact, it's the reason I wrote my first book, which really, for my own analysis, why do so many banks in the U.S. fail? There's a good reason why these stocks plummeted. In fact, if you go back to the 90 letter that that Buffett wrote for the Berkshire Hathaway annual report, he makes it real clear he's not a big fan of banks. He thinks banks are lemming. They follow each other off the cliff, and my goodness, that is exactly my observation as well. And then he in several articles or letters over the years, writes about how inadequate bank boards or directors in general are, but he has actually spotlighted the weakness of some bank boards in particular.
Interesting. Okay, well, I guess we'll stick with Wells Fargo a little bit longer, and then if we have time, we can come back and talk about the letters. I really want to do that, but that's probably way too much for our time today. So really looking back on Buffett's view of Wells Fargo, a little bit of that history leading up to what was going on, or what's been going on, or revealed to have been going on in recent months. Can you briefly share with us what's happened in recent months, all the news with Wells Fargo, kind of what was going on, and then share your thoughts as far as what Buffett may or may not do in response to it?
Okay, let me tee that up by saying there's certain periods or epochs of time for Buffett regarding Wells Fargo. The first was that decade of the 90s when he bought his initial shares and then began unwinding a little less than half. Then in 02 to 07, he was a big buyer. In fact, by 07, I think the record shows he bought a ton of shares and basically overpaid based on what happened 08, 09. He started buying back shares between 09 and 2015. Interestingly, even when Wells' stock fell in price to less than $10 a share in '09. He wasn't a buyer at that time. It looks like he began buying back shares or buying shares in Wells later in '09 when things started to look better. I would think it was that time was when they had acquired Wachovia, and it was becoming more and more clear that Wachovia was a home run. Wachovia, in many ways, has been the catalyst of the earnings surge at Wells Fargo over the last 5 or 6 years. So now you fast forward to 2014. He doesn't buy any shares because the price at that point is pretty high, $50 or so. But in 15, he ends up buying more shares at an average price around $52. And consider today, late October, it's around $45. You can see he's lost money on those shares that he's bought. So what's happened over the last few months actually is predated by what's been happening in the culture of Wells Fargo. Wells has been a superstar in the industry. In my second book, I actually have a chapter about why Buffett owns Wells Fargo and U.S. Bank. And the punchline is they both achieve much higher returns on shareholder capital than other banks, and they do it consistently. And so they create what I call a risk-adjusted return on equity that's superior to the marketplace, and they've been rewarded with higher PEs, higher multiples of book value. But the key drivers, in theory at least, to why Wells has been able to get superior returns is because they do a better job than other banks of deepening relationships with their customers, which is then acknowledged with the high cross-sales ratio. Average customer there has over 6 products per household. That's about twice what the average bank is. Well, it turns out that perhaps they had gone a little too exuberant, and we're still digging out. I'd say the industry and the regulators are still digging out what the real details are there. But in 2014, the LA Times did an expose on this, and that was then followed up this year by a lot more revelations that were brought as a result of some legal settlements with regulators.
And the idea, again, from the outside looking in, my perspective, my understanding is that were they creating fake accounts, or that's the accusation at least?
There are some 2.1 million accounts that were created, some of which you would say were fake accounts. Customer might come in and want to and acquire a checking account, but they would also be given a credit card, and they may not have even known that they had the credit card.
Gotcha. Okay. And so the benefit to Wells in doing that is, I guess, they could report to shareholders that their number of accounts are growing dramatically, which significantly, which seems to communicate, obviously, the bank is flourishing in ways that may not actually be true.
Well, I think that is the headline. And if you look at the quarterly calls that John Stump, the former CEO and chairman, had with his shareholders, one of the very first bullet points highlighted every quarter was that cross-sales ratio. So yes, it was a headline ratio that they saw as great evidence of the success of their strategy.
So in light of this, what were some of your conclusions as far as what you're expecting Buffett, how he may respond to this, as far as holding steady, selling, buying into the opportunity?
Well, I draw 3 conclusions from my analysis, and they're my best guesses. Number one, I cannot imagine that he'll be a seller. There is nothing in his record that shows that he is sold during a panic time. Number two, if anything, it's probable that if other shareholders panic, and I define that as seeing the Wells price of a share go down less than $40, I'd say it's probable that he would be back in the market trying to buy, provided the Federal Reserve allows him to, because as it currently stands, he does not have the ability, or Berkshire doesn't have the ability to buy more shares, because the Federal Reserve blocks an individual or entity from more than 10% ownership without their approval. He is seeking that approval. The public record shows since July, at least. So we'll see.
Interesting.
And I think number three, and I suggested that management is very, very important to Buffett. And I intimated that it's likely there'd be management changes. And we've seen that now in the past couple of weeks with Stump's retirement. And I would not be at all surprised if we don't see some pretty significant changes on the board by the time the next election occurs.
And do you know what's the board ratio as far as Berkshire representation?
0.
Oh, Berkshire has 0 representation, really?
Yep. It's a typical big bank board in that it has hardly anyone on the board with any share ownership at all. And if you look at insider buying and selling over the last couple of years, you'll see that the directors have not been buyers. And that's certainly a factor that I look at very carefully as a bank investor is I want to know what's management doing, because my experience suggests that management and sometimes directors are pretty clued in as to the best times to buy shares. I wrote another article for Seeking Alpha on that topic, basically saying you'll know when it's time to buy Wells when the insiders start buying, like they did at JP Morgan Chase and KeyBank and Cullen Frost Bank back in February of this year.
Well, that's perfect, because my next question was going to be, what is your opinion as far as what shareholders or investors should think of as far as whether this is an opportunity in Wells or not? So I guess the answer would be, don't do anything until insiders do.
Well, I just share my view. I have not been a Wells shareholder, even though I have currently own more than 10 banks. I did not think that the valuation, the multiples, were deemed enough of a margin of safety as you have with some other banks in the U.S. Over the past couple of years. That might be changing over the next. We'll see if that changes over the next year. But the flip side of it is there are a lot of uncertainties about Wells Fargo. We know that the return on equity is declining pretty steadily, and I think the multiple premium that they're seeing, particularly in the price to book, could be at risk. We'll see.
Well, so where is that coming from, do you think? I mean, that's bigger than this. The recent headlines about new accounts and stuff. So it sounds like even apart from that, they've got other problems going on fundamentally.
So does the whole industry. Okay. The core of that problem is really since the early 90s, banks have been adding capital, a significant amount of capital, and it's showing up in their capital ratios. And so the majority of U.S. banks today, and this is a big subject of my second book, do not create sufficient returns, sufficient to cover their cost of capital. If you can't cover your cost of capital, stock prices won't go up, mergers will occur, and that's exactly what's going on in the industry. Mergers at a faster pace than ever been in the last 30 years.
So what's making you hold on to 10 banks? I guess you see that, just because the overall industry is struggling with being able to cover their cost of capital. Obviously, that doesn't mean every bank is. So I guess you found some that you feel like are the exception and or maybe are great acquisition targets.
Actually, I don't focus in on acquisition targets, although that, in fact, some of my favorite banks have been, which disappoints me because I think a lot of these are good long-term holds because they provide superior returns with a moderate amount of risk. But I'll tell you, the other side of it is, especially since Brexit, Brian, in late June, banks really went on sale at the end of June. It was a nice time to buy, but we've seen some run up in prices over the past 4 months that caused me to step back and evaluate whether a few have become more pricey than I think they're worth.
Well, there's 2 questions on my mind, or lots actually, but 2 that I'll ask right now. One, I'm curious if you feel the freedom to share any of the banks that you really like right now. And the other question is going to be, as a sector, do you think, are you weary of investing in banks overall right now? I mean, I guess I want to get more of a feel for your thoughts of the overall sector, because with the impact on interest rates and you hear about, it just seems like a lot of banks are struggling, and you've already mentioned that. So I guess I wanted to hear a little bit more about your thoughts there.
Okay, let's do interest rates first, because
Okay.
I've written extensively for Seeking Alpha, as well as in my second book, about the misleading guidance that's going on about the influence of interest rates on bank profitability. My own experience as a banker was that when rates went up, we scrambled. We worried a lot. And so when I started reading a couple of years ago that banks are going to make a lot more money when rates went up, it was just totally contrary to my own experience. And so that caused me to go back and dig into the FDIC data and other sources of data. And not at all to my surprise, the data does not back up the notion that banks will make more money when interest rates rise. And so you could see that in either my second book or with more current data, the several articles I've written for Seeking Alpha back, I think, in August and early September. But with that said, what I do like about banks and why I'm investing in banks are a couple things. One, the valuations in many cases are still very reasonable, on a historic basis or relative to the rest of the market. And so I'll give you a couple examples. PNC, Huntington Bank, HBAN, Fifth Third. What you'll see is those three have all got, my favorite ratio, the Graham multiple, Benjamin Graham's PE times price to book.
Okay,
that have been around.
The third one, I'm sorry.
The third bank, Fifth Third, FITB.
Okay.
FITB.
Right. Okay.
So those are three examples of Midwestern banks that the market doesn't necessarily value very highly, and each one has its own story. I also I've liked JPM in the 50s. Jamie Dimon, their CEO, was a big buyer, $25 million of his own money at $53 and something. It's now coming up to 70. I think it's gotten a little pricey at that level. But, some of these banks, Huntington, people were dumping their shares at $8.15 at the end of June. Now it's approaching $11. They're in the midst of a merger with First Merit. And First Merit's actually, record shows pretty good bank. And so likely Huntington will be able to extract a lot of cost out of it. And if you look at it, they'll cover their cost of capital. PNC, interesting thing about them, and I may be doing some writing about them for Seeking Alpha. PNC owns almost 22% of BlackRock, and we could probably spend 30 minutes, Brian, just on PNC and
Sure.
Why that one in particular was puzzling to me when the shares dropped the end of June to less than $80 a share. It's now in the mid 90s, but banks continue to be pretty moderately priced relative to history. But people thinking that they're going to make more money when rates rise are just going to be surprised. They might have a little short-term blip up, but there are a lot of reasons that won't happen.
Well, I guess maybe on another podcast, we'll get back on here together and discuss some of those reasons, because that would be really fascinating to do since, as you mentioned, that's the prevailing thought. I just had someone on the show recently who we were talking about interest rates and the chase for yield, and Deutsche Bank came up. And, their struggle to get the return on capital, as you mentioned earlier, is it was almost entirely due to low interest rates, which, again, I'm by no means an expert in the industry, but even to me that seemed odd, because my thinking would be that, banks would charge whatever rates they needed to charge to do well. But again, I guess the issue being if the prevailing market has lower rates, then you can't raise your rates to get the income you need, because no one will come borrow money from you. But it'd be fascinating to hear your perspective from an insider view, but also all the data that you're bringing to the table just makes a lot more clear conclusions, I guess.
There's only one or two banks that are clear-cut winners, at least over an intermediate term, with rising rates. And the first one is JPM. And my articles for the Seeking Alpha explains in detail why JP Morgan Chase would be a winner. Also likely there in Texas is Comerica. provided the oil prices don't go south on them. Comerica will do very well. And by the way, it all comes down to a couple reasons. One, it gets back to your cost of funds. Comerica in particular has a very low cost of funds, lots of commercial checking accounts. Two, it comes back to how much variable rate loans you have versus fixed rate. Comerica has a lot of variable rate commercial loans. Again, a characteristic of a bank that'll win when rates go up. Mm-hmm. And then third, you have to have a fairly moderate loan to deposit loan relationship. And the lower the loan to deposit ratio, the more likely you'll be able to keep your rates low on deposits.
Awesome. Well, hey, Rick, this has been fantastic. I think I could stay for about 6 or 7 hours and ping you with questions.
Sure.
But I won't do that to you today, but I really appreciate you giving me some of your time, and we'll hopefully look forward to doing it again sometime.
Okay, Brian, thanks so much. Good talk.
Well, hope you enjoyed today's show with Rick Parsons. Remember, you can get full show notes with links and any other info you may want at investinthefamily.com. Don't forget to subscribe at iTunes, Stitcher, or the Google Play Store. And if you want to receive a summary sheet of my personal notes and highlights from the show, simply text the word Family Notes to the number 44222. That's one word, Family Notes, to the number 44222. Or visit investinthefamily.com and sign up, and we'll make sure to take care of you. This is Brian, and thanks for joining the family. Information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.